Corporate news will be coming at us thick and fast in the week ahead, so I'm going to gloss over what is, thankfully, a fairly quiet slate of macroeconomic data and get stuck straight into the companies. While these dates can be subject to change, there is about 18 FTSE 100 firms due to report interim or full year results in the coming week, with some interesting mid and small cap names primed to join them. It may be worth paying particular attention to the following. Support service specialist Bunzl, Primark owner Associated British Foods, and real estate investment trust Hammerson on Monday the 25th of February. At house builder Persimmon, Standard Chartered and chemicals expert Croda on the 26th. ITV, Rio Tinto and another house builder Taylor Wimpey on the 27th. Rolls-Royce, International and Consolidated Airlines, Mondi and Aston Martin Lagonda on the 28th. And then last, but by no means least, on Friday the 1st of March, St David's Day, we'll have WPP and Rightmove. But even allowing for that long and august list, the company most capable of causing a fuss in the week ahead could just be British American Tobacco when it releases its full year results on Thursday the 28th of February. BAT has a big portfolio of cigarette brands that includes Dunhill, Pall Mall, Kent and Lucky Strike, as well as oral tobacco products like Snuff and Snooze, and what it also calls next generation products, NGPs, or potentially reduced risk products such as Vapor, where BAT is developing Vipe, Views and Glow, amongst others. Now, whether you're familiar with these names or not, I can tell you one thing for certain. BAT has been an awful stock market performer of late. In stark contrast to much of its history on the London market, BAT shares are down nearly 40% over the past year, a run so bad it ranks 99th out of 100 by share price performance over the last 12 months within the FTSE 100. Only TUI has done worse if you're interested. 3 big picture factors have weighed on sentiment towards the stock. First, BAT was dismissed as a bond proxy. As the Federal Reserve raised interest rates and government bond yields went higher, particularly in the US, many investors sold yield stocks like BAT because they get a safer, decent yield from bonds without taking the capital risk posed by shares. Second, big tobacco firms are hemmed in by regulation on advertising, brands, packaging, you name it. The result is that global stick volumes are falling, especially in the developed West. And the third big picture issue, well, regulators are already scrutinising next generation products. America's Food and Drug Administration launched a crackdown on menthol and flavoured cigarettes and cigars to combat what it described as an epidemic of e-cigarette use among American teenagers. That clampdown came last autumn, and in addition, market newcomer Juul has been taking share in this area. Now, as if those 3 big picture issues weren't enough, there are also 3 company-specific issues to watch. First, BAT had to scrap its target for £1 billion of sales from next-generation products in 2018, thanks to weaker than expected uptake in Japan and a product recall in America. Second, currency movements went against the firm last year. And third, analysts continue to wonder whether BAT had just taken on too much debt with its 2017 move to acquire the 58% of Reynolds American it didn't already own, and it did so for $49 billion. So this set of full year results will be Chief Executive Nicandro Durante's last, before he hands over the reins after 8 years to Jack Bowles in April. Doubtless he'll be hoping to go out in a blaze of glory, and there are 4 particular sets of numbers which analysts will be particularly keenly watching. The first, well, that's the sales mix between volume and price. Overall, BAT has been forecasting a 3.5% drop in global sales volumes for the industry, which it will look to offset with market share gains and a 5.5% price increase, achieved through brand mix and just straightforward price increases. Second comes earnings per share, or EPS. Management's already trimmed its forecast here thanks to a 6% hit from unfavourable currency movements. Analysts are looking for adjusted earnings per share growth of around, or adjusted earnings per share of around 293 pence. That's growth of 2% year on year. The third figure is net debt. BAT has a plan to deleverage or reduce its net borrowings, and at the first half stage net debt was around £46 billion, compared to around 17 billion before the Reynolds deal. And in the end, the lower the debt, the safer the dividend. And that's the fourth and final headline number to note. BAT is forecast by analysts to pay an annual dividend of 200.25 pence for 2018, an advance of 3% on 2017, adding to a streak of increases in the distribution that stretches back to 1998. As a final point, remember that BAT pays dividends on a quarterly basis, with the 4 payments due in May, August, November and February, so 3 have already been made. Besides the final numbers for 2018, also watch out for any guidance for 2019 on all of those fronts. Just in case, as the previous graphic suggested, analysts are looking for the following. Sales growth of 5% to £25.7 billion for 2019, earnings per share growth of 8% to 316 pence, and dividend growth of 5% to just over 209p a share. If that forecast is met, that'd put BAT in a forward yield of some 7.6% based on a share price of around £27.50. Thank you for watching, and I look forward to seeing you next time.